Welcome back to the Deep Dive. Today, we are undertaking a really intense exploration into what is arguably the most complex, politically charged, and just foundational program in the American social safety net. We're talking about Medicare.
It's this massive federal health insurance program.
Absolutely. It covers over 65 million individuals. The majority, of course, are seniors, but it also includes younger people who are living with very specific, very severe disabilities.
It is, the bedrock of healthcare for the elderly in this country. And when you look at the sheer scale of it, you start to understand why every political debate eventually circles back to it.
The numbers are just staggering.
They really are. We're talking about an entity that commanded, over $900 billion in total spending in 2022. But like you said, it's anything but simple.
Right.
It operates across 4 distinct, sometimes contradictory parts A, B, C, and D. And each one has its own funding mechanisms, its own rules for providers, and frankly, its own set of solvency challenges.
So our mission today is a very specific one for you, the listener. We really want to cut through all that alphabet soup and provide a truly clear, structured understanding of Medicare. We need to uncover its history, and it has some surprising social impacts you might not know about, and then break down exactly how this multi-trillion-dollar commitment is funded.
And, critically, explore the major financial and policy challenges that are being debated in Washington right now.
Exactly, because those challenges, they directly affect everyone who pays into or relies on the system.
And I think we have to set the stage with the financial reality right up front. This is not like your private 401k or, a typical insurance premium you pay every month.
No.
Medicare is, at its core, social insurance. The connection between what an individual pays in and what they get back is, it's non-reciprocal.
That's the key distinction, isn't it?
Yeah.
It's not just a retirement savings account you're drawing from.
It is not. Consider this analysis from 2013. It studied households that were retiring right around that period. And the data showed that, on average, those households paid only between 13% and 41% of the total dollar benefits they are expected to receive from Medicare over their lifetime.
Wait, hold on. So even the most generous contributors, the ones at that 41% mark, they still only covered less than half of their expected benefits.
Correct. Which means the majority, that substantial 59% to 87% gap, is being financed by the dedicated payroll taxes of younger, currently working generations.
Wow.
That generational commitment, the fact that younger people are financing the benefits for today's retirees, that is what makes the long-term solvency of the Part O trust funds such a high-stakes political and, you could say, moral issue.
That reframes the entire discussion immediately. It's a massive wealth transfer from the current workforce to current retirees, all driven by a national commitment made decades ago. Okay, let's unpack that commitment, starting with the historical context. So Medicare was enacted in 1965, but the forces that drove its creation had been building for years. What was the state of healthcare for older Americans in, say, the early 1960s?
The situation was becoming economically untenable. Before 1965, if you were over 65, your risk profile was high, your income was often fixed and low, and the private market was simply failing you.
So insurance was hard to get.
Very hard. Only about 60% of people over the age of 65 had any health insurance coverage at all. That's significantly lower than the nearly 75% coverage rate that the younger population enjoyed at the time.
And even if they could get insurance, I imagine it was prohibitively expensive.
Absolutely. Older adults were paying more than 3 times as much for coverage compared to younger people. For so many, a single major illness meant complete financial ruin.
The classic case of market failure, then.
It's the foundational justification for social insurance. The private market could not efficiently or equitably provide necessary coverage to this large, vulnerable group.
So when did the idea really transition from just a policy concept to a serious legislative goal?
The concept had been around for decades, really, but it gained formal, sort of modern traction during the 1961 White House Conference on Aging. Throughout the early 1960s, attempts to pass a bill were repeatedly stalled.
Why was that?
A lot of it was strong opposition from the American Medical Association and conservative members of Congress who were very worried about socialized medicine.
So it was a battle over government involvement versus private control of healthcare.
Entirely. But the political landscape shifted in 1963. A bill that included the Medicare concept finally passed the Senate, and that was a huge symbolic breakthrough.
Why so huge?
Because it marked the very first time one chamber of Congress had officially approved the principle of federal responsibility for the health coverage of the elderly. Once President Johnson secured a big Democratic majority in 1964, the legislative path was finally cleared.
And on July 30th, 1965, the Social Security amendments were signed into law. And that gives us that iconic historical anecdote that really cements the program's intended legacy.
Indeed. President Lyndon B. Johnson, he signs the legislation in Independence, Missouri, which was the home of former President Harry S. Truman, who had championed this idea for years.
Right.
And Truman and his wife, Bess, were immediately enrolled as the first official recipients of Medicare. It was this powerful signal that this was about dignity and honoring previous generations.
But I found this next point in the sources particularly fascinating. It shows the immediate, powerful, and you could say unintended social leverage of the program. Medicare became an instant driver of civil rights.
It's an incredible, often forgotten chapter in Medicare's history. It was enacted in 1965, right? By 1966, Medicare started making payments to healthcare providers, hospitals, nursing homes, physician practices.
Right.
But those payments were contingent upon those institutions desegregating. Any healthcare provider receiving federal funds, which Medicare provided, had to comply with the 1964 Civil Rights Act.
So the government basically used the financial muscle of this massive new spending program to enforce racial equality in medical settings nationwide. That's a staggering example of policy leverage.
Absolutely. It forced immediate integration across the entire healthcare landscape. That's something the Civil Rights Act enforcement alone might have taken years and years to achieve. It really proves that Medicare wasn't just a health reform. It was a profound social and economic lever.
So the program was born, but it didn't just stay static. What were some of the early expansions that solidified its role as this broad safety net?
The evolution began almost immediately, starting with specific service coverage. By 1972, expansions included physical therapy, speech pathology, and later chiropractic services. Then hospice benefits were introduced in 1982.
And crucially, eligibility expanded beyond just the age 65 threshold.
Yes, and this is where we see the program start to address specific high-cost diseases, regardless of the patient's age.
Okay, so who else became eligible?
Individuals with permanent disabilities receiving Social Security Disability Insurance, or SSDI, they become automatically eligible for Parts A and B after a 24-month waiting period.
And what about for really severe conditions?
Well, for those facing severe chronic conditions like end-stage renal disease, ESRD, which requires dialysis or a transplant, they gained early eligibility. And for patients diagnosed with amyotrophic lateral sclerosis, or ALS, they're granted immediate eligibility. Enrollment begins the month their disability benefits start, so it completely bypasses that typical waiting period.
That 24-month waiting period for standard SSDI beneficiaries is an important detail. But the immediate enrollment for conditions like ALS really underscores the program's role in providing catastrophic coverage quickly when it's most needed. So this program is massive, it's complex, it's constantly evolving. Who actually steers this trillion-dollar ship?
The main body is the Centers for Medicare and Medicaid Services, or CMS. It's part of the Department of Health and Human Services, HHS.
And what's their job?
CMS sets the rules, manages the finances, regulates the private plans we'll talk about, Part C and D, and monitors quality. They're the architects.
But they don't handle enrollment or premiums for the most part, right?
No.
That falls to a different agency.
Correct. The Social Security Administration, the SSA, plays a very distinct and critical operational role. They determine eligibility, particularly for those turning 65 or receiving SSDI.
Oh, wait.
They also handle the collection of most premiums and manage the payment subsidies for low-income beneficiaries in Part C and D. It's a significant administrative separation that, frankly, often confuses beneficiaries.
So it sounds like CMS is the architect and the rulemaker, and the SSA is the gatekeeper and the bill collector. And who's the final check on the financial health of the system?
That rests with the Medicare Board of Trustees. Their job is to report annually on the financial status of the dedicated trust funds.
And that report is based on what?
The backbone of that report comes from the chief actuary of the CMS. This actuary provides a crucial, non-political opinion and projection regarding the expected revenues and expenditures. And that is what gives us the famous insolvency dates we hear debated every single year.
Let's quickly just confirm the eligibility essentials, because this is where the rubber meets the road for future enrollees.
The fundamental requirements are pretty simple. You must be a U.S. citizen or a permanent resident who has lived in the country for at least 5 continuous years. Generally, you must be 65 or older.
And what about the work requirement?
Crucially, if you or your spouse worked and paid Medicare payroll taxes for 40 or more quarters, that's 10 years, you qualify for premium-free Part A.
Ah, so that's where the premium-free part comes from.
Exactly. If you meet that threshold and you're receiving Social Security, enrollment in Parts A and B is automatic when you turn 65.
And the distinction about Part B is that, unlike Part A, you can proactively opt out of it if you have credible coverage elsewhere, say through a large employer.
Yes, that is vital. Part B has a premium, so if you have other comprehensive coverage, you must decline Part B to avoid paying unnecessary premiums.
So the key takeaway from this foundational history is that Medicare is not charity or simple welfare. It's fundamentally social insurance.
Right.
It's designed to ensure protection for the elderly, regardless of their current income or prior health history, and it's backed by decades of mandatory lifetime contributions.
It's a collective pooling of risk and resources, designed to handle a market problem that private insurance simply could not solve efficiently.
All right, let's navigate the alphabet. We're going to start with original Medicare. Parts A and B. This is the core government benefit. Part A, hospital insurance, sounds straightforward, but its cost structure is anything but.
Not at all.
What exactly does Part A cover, and how is this benefit period structured?
So Part A covers inpatient hospital care necessary, and I really want to stress the word necessary, brief stays in a skilled nursing facility, or SNF, and hospice care.
Okay.
The structure is based on the benefit period, which is very counterintuitive. A benefit period begins the day you are admitted as an inpatient, and it ends only after you have been out of the hospital and out of a skilled nursing facility for 60 consecutive days.
Okay, so if I'm discharged from the hospital, I go home for 2 weeks, and then I get readmitted for the same or a related condition, am I still in the same benefit period?
Correct, you are. And that means you do not have to pay the big Part A deductible again.
Uh-huh.
However, if you are out of the system for 61 days or more, the benefit period resets, and you would be liable for a brand new deductible upon readmission.
Let's talk about that liability. What are the out-of-pocket costs for a beneficiary for a single benefit period, let's say using 2024 numbers?
The costs are set up to protect against short stays but really punish long ones. You face a $1,632 deductible for days 1 through 60 of the inpatient stay.
So that one payment covers the first 2 months.
Right. Then the cost sharing begins. It's a $408 copay per day for days 61 through 90.
Per day.
And if you exhaust those 90 days, you move to your lifetime reserve days, which total 60 days across your entire life, and those have an even higher copay, $816 per day.
That is a staggering liability if you face a prolonged, complex hospitalization. And I assume if you exhaust your lifetime reserve days, the cost sharing hits 100% out of pocket for any further inpatient care.
It creates a major financial vulnerability, and that's a key reason why supplemental insurance is so popular. But the real complexity of Part A is best demonstrated by the infamous 2 midnight rule.
Okay, I've heard of this. What is this rule, and why does it cause so much anxiety for hospitals and patients alike?
This is where the distinction between Part A and Part B becomes so critical. The 2 midnight rule, which was implemented by CMS, states that Part A, so the inpatient payment, is generally appropriate only if the attending physician expects the patient's care will require them to cross 2 midnights in the hospital.
The physician expects it to.
Yes. If the physician expects a stay of less than 2 midnights, the patient should technically be classified as an outpatient, even if they're in a hospital bed.
So the core issue is that the payment determination is based on the expectation of the physician at the time of admission, not the actual duration of the stay.
Exactly. If the expectation is less than 2 midnights, the hospital gets reimbursed under Part B for outpatient services, even if the patient is occupying a hospital bed and receiving intensive care.
Why does that matter so much to the patient? Because their financial liability changes dramatically, I assume, but also because it messes with the patient's ability to qualify for follow-up care.
You've hit on the 2 key points. For the patient, being an outpatient often means greater cost sharing because they're paying co-pays for individual services under Part B rather than that single deductible under Part A.
Oh,
But the greater trauma is the skilled nursing facility, or SNF, eligibility. Part A coverage for an SNF stay requires a preceding minimum 3-day inpatient stay, meaning 3 midnights.
so walk me through this. If a patient is admitted on a Friday, stays Saturday, but is discharged Sunday afternoon, that's less than 3 midnights, they might have been classified as an outpatient the whole time.
They might have been. And if so, they lose the ability to qualify for crucial subsidized rehabilitation in an SNF.
Even if they need it.
Even if their doctor says they absolutely need that rehab, Part A won't pay for it because they never officially had a qualifying inpatient stay.
So a patient could have been in the hospital for 48 hours, critically ill, receiving the same care as someone deemed inpatient, but their admission status under this rule denies them access to the subsequent S&F benefit.
Precisely. It's a very counterintuitive bureaucratic mechanism. It's designed to limit high-cost Part A short stays and ensure that Part A is reserved for truly acute, lengthy hospital care. But it has these major downstream consequences for patients.
That is an excellent breakdown of a deeply complex issue. Yeah. Okay, let's shift gears to Part B, medical insurance. This is the coverage most people use most often: doctors, testing, outpatient procedures.
Part B is your routine outpatient coverage. It covers physician services, including surgeons and specialist diagnostic tests, durable medical equipment or DME, like oxygen tanks or wheelchairs, and ambulance services.
Right.
And crucially, unlike Part A, which focuses on acute care, Part B covers 100% of many preventive services, like annual wellness visits, flu shots, and mammograms, as long as you use an in-network provider.
Now, the cost structure here is simpler, but it's what creates the biggest financial risk for beneficiaries.
It does. The standard monthly premium for Part B is projected at about $185 for 2025, though wealthier beneficiaries pay more, which we'll discuss later with IRMAA. After you meet a relatively small annual deductible estimated to be $257 in 2025, the critical 80-20 split takes effect. Medicare covers 80% of the approved cost, and the patient is responsible for the remaining 20%.
And that 20% coinsurance is the defining feature and the massive risk, because original Medicare has no out-of-pocket limit.
None.
So if you have a $500,000 cancer treatment that's paid for under Part B, your 20% liability is $100,000.
That is the gaping hole in original Medicare. It's why virtually no financially prudent beneficiary relies solely on Parts A and B. They immediately seek supplemental coverage, which leads us perfectly to Part C and D.
Let's move to Part C, Medicare Advantage. This is the private sector's alternative. How exactly does Part C function?
Part C is a form of managed care. Private insurance companies, which are approved and regulated by CMS, they contract with the government to provide all the benefits of Parts A and B, and often Part D, in one bundled package.
The MAPD plan.
Exactly, an MAPD plan. And they receive a fixed payment per enrollee from the government to do this.
So they are required to meet or exceed the coverage standards of original Medicare, but they get to redesign the benefit structure.
Precisely. They might charge a $25 copay for a primary care visit instead of that 20% coinsurance. They also typically offer extra benefits that original Medicare doesn't, like routine dental, vision, hearing, or even gym memberships.
That's the downside.
The downside is network restrictions. About 75% of these plans are HMOs or PPOs, which require you to use specific doctors and hospitals.
But the most crucial financial benefit, the one that really drives enrollment, is the mandatory OOP limit.
Absolutely essential.
Right.
Because original Medicare Parts A and B leaves that catastrophic risk wide open, Part C plans legally must include an annual out-of-pocket spending limit.
Correct.
And while that limit can be high, it can range up to $9,350. It provides a crucial cap on a patient's financial exposure for the year. That's a major comfort for seniors who are managing fixed incomes.
So Part C is a trade-off. You get a financial safety net and some extra benefits, but you give up freedom of choice regarding your providers and networks.
That is the simplest way to explain the fundamental difference. The choice really hinges on whether you value unlimited provider access, which is AB plus a Medigap plan, or limited financial risk, which is Part C.
Okay, finally, Part D, the prescription drug benefit. This was a huge addition, enacted in 2003 and went into effect in 2006.
Part D covers self-administered prescription drugs, both generic and brand name. It's available to anyone enrolled in Part A or B.
And it's all run through private companies.
Entirely. Part D is administered entirely through private insurance sponsors, which are regulated by CMS. They contract with pharmacy benefit managers, or PBMs, to manage their formularies and negotiate prices with manufacturers and pharmacies.
This decentralized private negotiation structure is often touted as why Part D has been financially more successful than initially projected, right?
Yes. The competitive model encourages plans to negotiate aggressively, which is why critics often point out that the cost of Part D has run well under the original projections. But this private system means that plans have formularies lists of covered drugs that can vary widely from plan to plan.
And what rules govern those formularies? What do they have to cover?
CMS requires plans to cover at least 2 drugs in 148 different therapeutic categories. But the most important rule relates to 6 protected classes of drugs.
Which are?
Things like immunosuppressants, anti-cancer agents, and antipsychotics. Plans must cover substantially all drugs in these specific classes to ensure that vulnerable patients have access to the full spectrum of necessary medications.
And we have to talk about the notorious donut hole.
Huh.
What exactly was it and how was it closed?
The donut hole, or the coverage gap, it existed between the initial coverage limit and the catastrophic threshold. Once a beneficiary and their plan had spent a certain amount on drugs, the beneficiary would suddenly be responsible for a much higher percentage of costs, sometimes 100%.
Wow.
Then they'd stay there until they hit the catastrophic threshold, after which the plan paid almost everything. It was designed as a cost control measure, but it created immense hardship.
And the Affordable Care Act stepped in to mitigate this sharply.
It did. The ACA gradually phased out the donut hole by 2020. The mechanism was subtle. It lowered the beneficiary's required copay within the gap to 25%.
So it made the cost sharing in the gap equal to the cost sharing in the initial coverage phase.
Exactly. It effectively smoothed the transition, providing immense relief to the roughly 5% of beneficiaries who have very high drug costs.
Okay, so part 2 summarized. A and B is the core government coverage, but with major cost-sharing gaps. C is private managed care that provides a mandatory OOP limit. D is private, regulated prescription drug coverage.
That's a great summary.
Let's transition now to the financing puzzle. This is where the demographic pressures and the political battles truly converge. We established that Part A, the hospital insurance, is funded fundamentally differently than B and D. Let's delve into the mechanics of that Part A payroll tax.
So Part A is primarily funded by the hospital insurance, or HI, trust fund. Its revenue comes from a dedicated 2.9% payroll tax on all earned income.
And that's split between the employer and employee.
It is, split evenly, 1.45% each. A crucial point is that since 1994, there has been no compensation limit on this tax. Unlike Social Security taxes, you pay 2.9% on every single dollar you earn.
And there's an additional surcharge for high earners, right?
Yes. Since 2013, the rate increases to 3.8% for earned income exceeding $200,000 for an individual or $250,000 for a married couple filing jointly. But that additional revenue doesn't go to Medicare.
Where does it go?
It goes toward funding Affordable Care Act subsidies.
Interesting. So Part A relies on dedicated tax revenue, which is great for predictability, but it is acutely sensitive to that ratio of workers to beneficiaries. Where do Parts B and D get their money?
They're much more susceptible to general economic fluctuation and congressional appropriation. So they're funded primarily by general fund revenue from the U.S. Treasury, think income taxes and corporate taxes, and then supplemented heavily by beneficiary premiums.
And this brings us right back to the demographics that are crushing the HI trust fund.
Yeah.
The baby boomers are retiring en masse.
They are, and the numbers are just unforgiving. By 2030, the entire baby boomer generation will be 65 or older. Enrollment is projected to exceed 80 million people.
And the crunch comes from the worker-to-enrollee ratio.
That's the key metric. It's the number of people paying into the system versus those receiving benefits. And that ratio is projected to drop from 3.7 workers per enrollee to just 2.4.
That is a staggering 35% decline in the support ratio in a single decade. It means the burden on those remaining 2.4 workers to support current beneficiaries is just immense. That's why the solvency clock is constantly ticking.
It explains the political urgency perfectly. And speaking of burden, we have to discuss IRMAA, the mechanism by which the cost-sharing burden falls disproportionately on wealthier beneficiaries.
The income-related monthly adjustment amount.
Exactly. IRMAA is essentially a premium surcharge that's applied to both Part B and Part D. It kicks in when a beneficiary's income exceeds $85,000 for an individual or $170,000 for a couple.
And what does it do?
Depending on how far above those thresholds they are, these beneficiaries are forced to pay a Part B premium that can be 30% to 70% higher than the standard rate.
And it's important for listeners to know this calculation isn't based on your current income. It's based on the tax returns you filed 2 years prior. It's a lagging indicator.
It is. A recent retiree who had a high income 2 years ago but has a low income today might still be subject to IRMAA until their current tax status catches up in the system.
Okay, now for the part that I find most fascinating and technical, the provider payment systems.
Yeah.
How does Medicare, as this massive single payer, decide what a hospital or a doctor gets paid? Let's start with Part A, hospital reimbursement, and the DRG system.
Part A uses what are called diagnosis-related groups, or DRGs. This is a form of prospective payment. Instead of reimbursing the hospital for every single itemized cost, every pill, every bandage, every hour of nursing,
Right.
Medicare pays a single fixed amount based on the patient's diagnosis and severity.
So if a patient has a severe case of pneumonia, which is a specific DRG, the hospital gets X dollars, regardless of whether the care cost them X minus 10 or X plus 10.
That's the core incentive structure. It forces hospitals to be efficient. If they can treat the patient safely for less than the DRG payment, they get to pocket the difference. If they're inefficient, they lose money. It shifts the financial risk from the government to the provider.
But risk shifting creates incentives for manipulation, most notably upcoding.
Indeed. Upcoding is the practice where hospitals might inflate the severity of a patient's diagnosis just to qualify for a higher-paying DRG. It's a constant regulatory battle for CMS to ensure that hospitals are paid accurately based on true patient need, not based on attempts to maximize reimbursement.
Okay, now let's move to Part B, physician payment. This system, the Resource-Based Relative Value Scale, or RBRVS, is where the story gets really interesting because the rates are set, in part, by a non-governmental entity.
RBRVS is the mechanism that determines the price for the roughly 7,000 services that physicians perform. It attempts to price services based on the resources required. So, physician work, practice expense, and malpractice insurance. These are all converted into relative value units, or RVUs.
The core controversy isn't the formula itself, but who dictates the value of those RVUs.
Precisely. The initial values and the regular updates to these RVUs are largely determined by the Specialty Society Relative Value Scale Update Committee, the RUC.
The RUC.
And this is not a federal committee. It is a private advisory panel composed of 29 physicians, primarily specialists, who are associated with the American Medical Association, the AMA.
So you're saying a private panel of doctors, who are often specialists, is advising the government on how much money doctors nationwide should be paid under the largest single health insurance program in the world.
That's exactly what I'm saying.
Why does CMS rely so heavily on this private body?
It's a stunning governance arrangement. The data shows that CMS adopts the RUC's recommendations about 87% of the time. The reason is, well, it's multifaceted. Firstly, the RUC provides detailed clinical expertise and cost data that CMS just does not have the internal resources to compile for 7,000 different services.
Okay, that makes some sense.
But secondly, and perhaps more importantly, reforming physician payment is politically explosive. By relying on a body that's made up of physicians, CMS gains a degree of clinical legitimacy and political cover. It helps them avoid a direct confrontation with the entire medical community.
So we have a system where payment rates are being heavily influenced by the very industry being regulated. And that influence tends to favor specialists who sit on the panel over, say, primary care physicians, whose services are generally valued lower by the RUC methodology.
That is the long-standing criticism of the RUC, that its structure inherently institutionalizes higher reimbursement for specialty procedures over routine primary care. And this impacts the entire supply and distribution of the physician workforce in the U.S., since Medicare rates often set the benchmark for private insurance as well.
This structure leads us directly to the legacy of the Sustainable Growth Rate, or SGR. Tell us about that formula and the political chaos it created.
The SGR was a disastrous mechanism. It was intended to control Part B spending growth by linking it to economic growth. If actual spending exceeded the SGR target, which it always did, the formula mandated steep, sometimes catastrophic, cuts to the RBRVS conversion factor.
Meaning a huge pay cut for every doctor accepting Medicare.
A huge pay cut, which of course would have caused a mass exodus of doctors from the Medicare system. The cuts were often projected to be 20%, 30%, or even higher. This led to what became known as the annual doc fix. Every single year, sometimes multiple times a year, Congress was forced to pass emergency, temporary legislation to override the mandated cuts just to keep the system functional.
It created massive unpredictability and turned physician payment into a yearly, high-stakes political drama.
It was a perfect encapsulation of political instability. The system was legislated to be fiscally conservative, but politically it was completely unsustainable. Finally, in 2015, Congress repealed the SGR and replaced it with MACA-RA, which shifted payment toward quality metrics, attempting to stabilize physician pay. But the SGR story perfectly illustrates the challenge of controlling costs when those controls conflict with the political need to maintain provider access.
We must now address the immediate future. The solvency of the Part A Trust Fund and the major policy reforms being debated right now.
Let's start with the big one.
Let's confront the $50 trillion number first, because it's so staggering it almost loses all meaning.
It's a number that requires a lot of context. The total unfunded obligation for Medicare over an infinite time frame is currently estimated at over $50 trillion. This represents the gap between projected tax revenues and the expected spending required to pay full benefits under current law.
That is nearly twice the size of the entire U.S. national debt. It implies that paying the currently promised benefits is mathematically unsustainable without massive, massive changes.
It does. And the more immediate issue is the Part A HI trust fund insolvency, which is currently projected for around 2026.
Now, insolvency does not mean the program shuts down.
Correct. It means that the dedicated payroll tax revenue will only be sufficient to cover about 85% of Part A costs thereafter.
So if Congress does absolutely nothing, Part A payments to hospitals and SNFs would immediately be cut by 15%. That would be catastrophic for the healthcare system.
It would be. And this is the political reality. The actuarial estimates assume that full benefits will be paid, but they also acknowledge that the long-term projections rely on the critical assumption that Congress will repeatedly step in to prevent the deep cuts mandated by current law, like those scheduled physician payment freezes after 2025.
It's a system designed to require political intervention just to remain stable.
That's a perfect way to put it.
But before we jump into the reform proposals, let's quickly reassure the listener about Medicare's efficiency relative to the private sector, because this is important.
This often surprises people who only focus on the solvency crisis. Despite the $50 trillion challenge, Medicare has been significantly more successful at controlling per capita spending growth than private insurance has.
By how much?
Medicare's projected growth rate is around 2.5% annually, while private insurance is projected at 4.8% annually. Medicare's massive size provides substantial economies of scale and negotiating power.
So it's not inefficient, it's a high-cost program challenged by demographics.
Yeah.
But the system does face profound internal inefficiencies when dealing with the most vulnerable, the dual eligibles.
The dual eligible dilemma is perhaps the largest administrative failure point in U.S. healthcare. These are the 9 million low-income individuals who qualify for both Medicare because of age or disability and Medicaid because of low income.
Okay.
This population is tremendously sick. Over half have 5 or more chronic conditions, and they account for a disproportionate 36% of Medicare's total costs.
And the core inefficiency is that the two systems are administered separately and often work against each other.
Exactly. Since Medicare covers the medical services and Medicaid generally covers long-term care and supplemental costs, both programs have financial incentives to shift costs onto the other.
Give me an example.
Okay, Medicare might send a complex patient home from the hospital early to save on Part A costs, knowing that the patient will likely end up back in the ER a week later, with Medicaid footing the bill for home services that could have prevented the readmission in the first place. The care becomes uncoordinated and fragmented.
The proposed solution is radically improved coordination, treating the person holistically. What are the potential savings there?
The potential savings are huge. Experts project that coordinating care for dual eligibles could eliminate $125 billion to over $200 billion in unnecessary hospitalizations and emergency visits. It's about connecting these patients with proactive primary care, better medication management, and necessary social services like housing assistance.
And this is one area where both sides of the political aisle usually agree on the necessity of reform.
For the most part, yes.
Let's turn to some of the legislative battles, starting with the long-running debate over drug price negotiation. Why has Medicare always been barred from negotiating drug prices centrally, unlike, say, the VHA?
Part D was designed to use decentralized private negotiation. Each of the hundreds of private Part D plans negotiates its own prices through their PBMs. Proponents argue that this competitive market model would drive costs down effectively. And, as we noted, Part D has performed better than expected financially.
But the comparison to the Veterans Health Administration is powerful.
It is the main argument for change. The VHA, which provides care directly, has the power to negotiate centrally for its entire patient population. And multiple studies have shown that the VHA pays substantially less for identical drugs than Part D plans do.
And this led to the Inflation Reduction Act of 2022.
It did. That act finally granted Medicare limited negotiation power.
How limited is it?
Very. It's not the VHA model.
Right.
Medicare will start negotiating prices only for a limited number of the highest cost drugs, starting with just 10 drugs in 2026 and increasing over time. And it only applies to drugs that have been on the market for a specified long period without any generic competition. It's a step, but it's not the centralized negotiation system many advocates had sought.
Moving to structural reform, let's discuss premium support. This is a fundamental philosophical shift.
Premium support proposes transforming Medicare from a defined benefit program where the government guarantees specific services to a defined contribution program.
Okay, what does that mean in practice?
The government would provide a fixed voucher or premium support payment, and beneficiaries would use that money to choose among competing private health plans. It's similar to Part C, but it would become the default model for everyone.
What's the major argument in favor of this?
The central idea is that robust competition between private plans, driven by the consumer selecting the best value, would drive down overall costs and force greater efficiency across the entire system. It injects market principles into Medicare.
And the major concern raised by critics.
Risk selection. Critics worry that insurers will innovate ways to attract the healthiest, lowest-cost patients, a practice known as cherry-picking, and avoid or discourage the enrollment of sicker, more costly beneficiaries.
Right.
This would leave the most vulnerable, high-cost patients concentrated in the remaining public fee-for-service option, potentially making it fiscally unsustainable and resulting in sicker patients receiving worse care.
Let's consider the debate over the eligibility age. We see proposals to both raise it and lower it. If we raise the age from 65 to 67, aligning it with the full Social Security retirement age, what are the financial trade-offs?
The immediate appeal is federal savings. The Congressional Budget Office projected that raising the age would save the federal government about $113 billion over 10 years. That looks like a big win for solvency.
But the Kaiser Family Foundation pointed out that this isn't free money, it's just shifting costs.
That's the critical insight. Raising the age forces 65 and 66-year-olds onto the private market. This often results in higher premiums for them, and it raises the overall premium pool for younger people. Kaiser estimated that the proposal would increase total social costs, so the combined outlays for the government, employers, states, and individuals, by more than twice the savings gained by the federal government.
So you save the government money, but you burden the overall economy and individuals more heavily.
Precisely.
Now let's discuss Medigap restrictions, a proposed solution to the moral hazard problem.
This proposal targets the idea that when a patient is fully insulated from cost, which happens when a Medigap plan covers that 20% coinsurance, they have no incentive to question or limit seeking unnecessary costly treatments. It's called first dollar coverage.
So policymakers propose introducing limits or surcharges to force patients to have some skin in the game.
Precisely. They want to discourage moral hazard. The most aggressive proposals suggested limiting Medigap from covering the first several $100s in coinsurance and restricting coverage above that. This could potentially save tens of billions of dollars over a decade by reducing what's deemed frivolous use.
What is the significant policy risk of increasing cost sharing for the elderly?
The fear is that increased cost sharing would disproportionately affect patients with low health literacy or those living on the margins. Instead of just discouraging unnecessary care, it might cause patients to delay or forego entirely necessary, potentially life-saving care like cancer screenings or essential diagnostic workups.
Which would lead to far more expensive hospitalizations later on.
Exactly. It's the constant dilemma, ensuring efficiency without sacrificing access.
Finally, the push for expansion into non-acute care, specifically vision, dental, and hearing services.
This was a major focus of recent legislative efforts. The Build Back Better legislation successfully added hearing services, which began to roll out in 2023, subject to the Part B deductible and that 20% coinsurance. However, the comprehensive dental and vision components were stripped out.
Yet, the data on unmet needs, particularly for vision, is overwhelming.
It is. Data from the Urban Institute showed that Medicare enrollees spend more out-of-pocket on routine vision services, $8.4 billion, than they do even on routine hearing services, which was $5.7 billion. This is a massive out-of-pocket expense that the system fails to cover.
And the inequality is stark.
Absolutely. The data clearly shows a severe income gradient. Lower-income beneficiaries, particularly non-Hispanic, Black, and Hispanic enrollees, spend dramatically less on vision services than high-income beneficiaries do. This suggests that the current coverage gap results in severe unmet needs among those who can least afford the care.
This expansion debate really summarizes the modern challenge of Medicare, doesn't it? Is the program just about covering acute, life-threatening crises like in Parts A and B? Or should it encompass the routine care necessary to maintain a high quality of life, like dental and vision?
That question will define the political debate for the next decade. #outro pet.
This deep dive has confirmed that Medicare is far more than just an insurance plan. It is a powerful economic and social driver. It sets benchmarks for U.S. healthcare delivery, and notably, it manages its per capita cost growth much more effectively than the private insurance market does.
And despite its relative efficiency, it is perpetually caught between the inexorable pressure of demographics leading to the Part A solvency crisis and the immense political pressure to both maintain current benefits and expand coverage,
Right.
all while relying on these highly technical, often private sector influenced payment mechanisms like DRGs and the RUC just to keep providers engaged.
For you, the learner, the key takeaways must be cemented. First, understand the fundamental huge difference between original Medicare Parts A and B with its high coinsurance and lack of an out-of-pocket limit versus Medicare Advantage Part C, which trades network freedom for a guaranteed financial cap.
Second, remember that original Medicare does not cover long-term custodial care, which is a crucial omission for planning purposes. And third, recognize the extraordinary influence that the private specialized RUC panel holds over how doctors are compensated nationwide. And let's end where we began, with that fundamental instability. We noted that the Medicare trustees' long-term financial health projections are predicated on a critical built-in assumption,
Which is?
that Congress will repeatedly step in to prevent the deep automatic benefit cuts and payment freezes that are mandated by current law.
So if the long-term solvency of Medicare is only sustained by this guaranteed mandatory political intervention year after year, then what does that imply about the stability and the political honesty of the program as it's currently structured?
Right.
It suggests the system is designed to fail financially unless politicians prioritize the doc fix over fiscal law, making the promise to current taxpayers contingent on constant legislative maneuvering.
It's a challenge that future generations must confront head-on, because that political promise is precisely what they are paying into today. Something to consider as you digest this colossal, fascinating program.
Until next time.